So what is Forex? Forex is one of the most traded markets in the world and is also known as foreign exchange or currency trading. It actually has over $5 trillion traded daily, so making it the most liquid market, meaning that you have the most potential to make maximum profits in this market. But in Forex trading, traders hope to generate a profit by speculating on the value of one currency compared to another. This is why currencies are always traded in pairs. The value of one unit of one currency doesn't change unless it's compared to another currency. So let's take a look at a currency pair, one of the most common ones, the Euro USD, so that we can speak a bit more in detail about this. Okay, so here on the screen we have an example of a currency pair. This is the Euro against the USD. So we're basically trading the Euro against the United States dollar, USD. So basically this is what we call our base currency. So we have a base currency and a quote currency. So this is the base currency, just base, as you can see written right there, and then this is our quote currency. So the second currency in the pair is called a quote currency. So this is our quote currency. So what it means is just that for you to have 1 euro, you need to have a certain amount of US dollars. So in this example, this is the amount of United States dollar that you need to have to be able to say, okay, you have 1 euro, one worth of a euro in United States dollar, you need this amount. So it's just like an exchange rate. That's basically what's going on there. So this is a perfect example of this. Is like when you have euros in your bank account and you want to buy something online, or you have visited United States and you have euros in your account, or you have euro in form of cash and you want to buy something in that country or online, but then the product is priced in United States, so United States dollar. So you're going to need to exchange your euros for that United States dollar. So the best way to do this, which is the common way, is to use the exchange rate. So this is basically the exchange rate, and if I take you through to the chart to show you how it actually looks live, this is basically the Euro USD on Trading View. This is a charting app that we use to analyze and all that stuff. So basically, as you can see, the market is moving up and down, and this is basically the current rate right now. That means for you to have 1 euro, you're going to need 1.14 US dollars to be able to have 1 euro worth of value in US dollars. So that's just basically the simple terms to put it, Forex trading and what it is. So basically everybody has done Forex trading in some point, but when it comes to Forex trading online, we're basically doing exchanging of rates and speculating the price so that we can make a profit in between from the movements that the charts are making and the movements of the price. So that's basically our main aim when we trading Forex online. But anyways, everybody has done Forex trading in some form, whether it's when you visit another country or when you are buying something online that is outside of your country. So that's basically Forex trading in simpler terms. But basically we have two trade opportunities when it comes to trading. So you're either buying the market or you're selling the market. So when you're buying, in case of this, let's just use the same example again. So when you're buying Euro USD, that means you are saying that this currency right here is going to gain a bit more value over the United States. So that means the graph is going to be on an uptrend. So maybe you found it right here and you're saying, okay, so the euro, I'm going to buy it because I'm seeing that it's going to actually gain value after you have analyzed and everything, and you maybe it's fundamental analysis or technical analysis. We're going to break that down later in the video. But basically, once you have analyzed and you've seen that, okay, there's a potential that the euro is going to gain value over the United States, that means the best option for you to be able to make profit from that market is to actually buy. So we have the sell and the buy orders. So when you buy, that means you're saying euro is going to gain value over US dollar. And when you're selling this pair right here, the Euro USD, you mean that euro is going to lose value compared to the United States dollar. So the United States dollar is the one that's gonna gain value, meaning that the chart is gonna start falling. So that's what happens. That is what is happening when the chart is falling from a certain point. So as you can see, this reversal right here, that means the market had reached a certain point where euro was gaining power, right? It was increasing in value against the United States dollar, but then at that point it turned around and then euro started decreasing in value compared to the United States dollar, and then it just came down here again. But as you can see, again it started boosting the power, it gains more power, and then it just increased. So that's basically the two trade opportunities that we'll be trying to engage in so that we can make a profit from that movement. So that's just the two opportunities that you have for you to be able to trade Forex and for you to be able to make a profit from that. So those are the two opportunities that we have, buy and sell trades. So as you can see right here with this illustration example right here. So we call this the bullish market. So buy trade, I'm pretty sure you've heard about the bulls and the bears. So basically how this term came to use is that when bears are attacking, they attack from above. So they attack from above going down. So they basically crashing something. So they just pushing something down, right? So those we call them the bears. That is when the market is selling. So those are bears. And then when we're buying, like the bull with his horns, it attacks from the bottom going up. So those are the bulls. So we call that market bullish when it's buying. So if a trade is buying and the trend is up, we call it bullish. And then when it's selling and the trend is going down, the market is going down, that means it's bearish. So that's just the quick terms, that the most common terms that you might actually need to understand before we dive into the the more advanced parts of this course. But basically bullish and bearish. Bearish, we're selling; bullish, we're buying. So this is an example right here again on Euro USD. If you bought here, that means you're in profits. Somewhere there you can close your trade. That's basically a buy trade and a sell trade right there, an example of that. So just to make it a bit more clearer, the buy or sell action you take to enter a trade always applies to the base currency. So as we said here, in our case, the euro is our base currency being opposed to the United States. So the opposition currency automatically applies to the quote currency. So if you buy Euro USD, this means you're buying euros and selling the United States dollar. If you're selling Euro USD, you are selling your euros and buying United States dollars. So in the forex market, one currency is always strengthening against another. So this means it's bullish. It's in a bullish uptrend, and therefore one currency is always weakening against the other, against another. So which means it's bearish. So it's going down. This is a downtrend, is a bearish. Because of this, you have the equal opportunity to buy or sell to enter the market. So what you need to get out of this video is that you have two opportunities in the market. You're either buying or you're either selling, and both ways you make a profit. If you predict the direction correctly, you will make a profit whether you're buying or you're selling. So it makes equal opportunities for buyers and sellers to be able to make a profit out of that. So anyways, let's jump into our next lesson. Okay, so 3 things that you need to understand before opening a trade are the following. Pips, you need to understand what are lots as well as your leverage. So basically when you create an account for the first time, you're going to be asked which leverage that you want to use. So for an example, if you opt in for a 50s-to-1 leverage, that means you can control up to $10,000 within an small account balance of just $250. So basically leverage is more like borrowed money that you are using to trade so that you can enter this big market and basically have the opportunity to have the potential to make huge profits compared to the amount of money that you have. This is why people can grow accounts beyond their initial balance and their initial deposit. So anyways, also the pips is basically the unit of measurement. So as you saw with our example of the Euro USD, we were measuring the value of basically the US dollar compared to the euro, right? So that value is what we call the pips. So basically we're going to explain a bit more in detail later on that one. And then the last thing is called the lot size. So what you need to understand about this is that we actually have 3 different lot sizes, different types of lot sizes. So we have the standard lot size, and then we have the mini as well as the micro. So these are the 3 lot sizes that you're going to be making use for you to be able to enter a market using this trading forex. So let's explain this a bit more in detail. Okay, so starting off with the lot size. So lot size is going to determine how much you are risking of your account, how much of your account you are risking. So lot size is actually more important because every trade that you're going to be using, you're either opening with a standard, mini or micro lot. So either multiple of each of these or just one. So basically this is the safest way to open a trade. This is the minimum that you can open on most accounts, unless if you're trading synthetic indices, which is another story. But for the forex trading, MT4, most of the MT4 instruments, you're going to be having this as your minimum micro lot that you can open. So to just illustrate this in the form of writing, you're actually going to be able to see something like this when you open a trade. So it's either you can open a 1.00, which is going to be our standard lot, which is price, which is worth 100,000 units, or you're going to have the mini lot size, which is a 0.10. So which is worth 10,000 units. And then we're going to have the smallest, which is the micro lot size, which is measured as 0.01. So you're going to open multiple of these. So you're going to have a 0.2 right here. So you can actually open a 2, you can open a 3, you can open a 4, up to that one, that up to 0.09. That means you are opening a micro lot, but you have opened 9 positions on that micro lot, right? So same thing as this. This one you can even go to 10, you can go to 100, depending on your balance that you have on your account. So that's basically so this lot size actually has an influence on how much you can make and how much you are risking of your account. So as I said, you can control $10,000 with just $250 on your account when you have a leverage of 50:1, as I explained in the beginning of the video. So this is where you'll be able to control it in more detail. So it will depend on whether you're going to open that one lot size that is one standard lot size that is going to control that 250 with just one position, or you're going to break it down into this amount, so you can have maybe different you can enter the market in different stages and have a more balanced risk management plan than just to open one position that will be pretty much more dangerous and more riskier. So anyways, that is what you need to know about lot sizes at the moment, and I would really advise you to follow along with the booklet and go read this again and again, and just understand the example that is been used to explain lot sizes right here. But then the second thing that you need to understand is going to be the leverage. So as we said, with a $250 account, if your leverage is 50:1, you can control a $10,000 position. So that's basically just what leverage is all about. It's about borrowed money that you can use to be able to enter the market with, allowing you to make more than what your initial balance is. That's why you can see people going beyond their initial deposit when it comes to trading balance in the amount of profit that you make, because you're actually trading with way more than what you actually have on your account, just because of leverage. So leverage, you can start from 1:1, which is the smallest. We wouldn't actually recommend you to trade with that, but at least a 50, that's something that you can start to manage your risk with. It's more manageable, it's less risky, but also means less profit, because remember, the more your leverage is, the more the lot size, the bigger the lot size that you use, the more profits that you have, but also the riskier your trade becomes. So it's all about taking risk when it comes to trading. So yeah, and then you also have something like 800:1. So this leverage goes all the way beyond 3000:1. So it just depends on your broker and which broker you're using, but most brokers offer up to 500:1 as your leverage. So again, it all depends on the broker that you're using, but that is all that you need to understand about leverage. You don't have much control over it unless so make sure that you actually take your moment to take a look at that, so that you know what your account leverage is, because it's really important when it comes to risk management and so forth. So now we're going to jump in and explain a bit more on pips. Okay, so to explain pips in more details, we're going to make use of this example here on the screen. So let's say you opened a 10 lot size trade on Euro USD and your account leverage is 50:1. Let's say you actually were able to, after your analysis and everything, you were able to catch this trade from 1.3, you bought it at that price, and then you successfully closed this trade at 1.3020. So that means you have earned 20 pips in this trade, and it's positive. This is your profit. This is the amount of profits in pips that you've been able to capture on this trade because it went in your direction. So in this example right here, 1 pip is worth $1 according to this calculation right here. So basically, as you can see, we have 20 of these, and then each of them is worth $1 if you multiply by $10,000, which is like the standard amount that you use to calculate your amount of pips. But basically, you need to note that not all pips are worth $1. So the value of the pip depends on the lot size of your trade, how many lots you are trading, the currency pair, and your account currency. So you can also manually calculate this online using online calculators, which will help you simplify it. So this is one of them that you can use. You can download it as an app. You can also install it on your devices and use it online. But basically, in this example, that means 1 pip is worth $1, and basically, if you caught this 20 pips, that means you now have $20 in profit. So that's just a basic example of lot sizes, of how lot sizes and your leverage can have an effect on your pips. so eventually having an effect on your profits and your losses. So that just means now you need to be able to understand what is your leverage, what is your lot size, and so that you can be able to understand the value of each pip. That way you'll be able to estimate the value of your pips that you're going to get in each trade. So before you even start trading, before you even enter a trade. So okay, so now that you know a little bit more about Forex, we're going to take a closer look at how to make your first trade. So when you're making your trade, you obviously have to select a currency pair. First, as we said in this example, we're using Euro USD, but there's a lot of those. As I showed you on TradingView, for example, you can just come here and then select and then search for a lot of currency pairs that you want to trade, and then once you have your currency pair, you're going to go to the market, open your chart, and then you're going to analyze. So once you analyze, we're going to use some what we call support and resistance, which what we're going to dive into a little bit later on. And then we're going to use some candlestick patterns as well. So there's a lot that you use to analyze the market and so forth. But once you have analyzed your market, the last thing is to choose your position. So by position, we're just saying basically the lot size, the amount of lot size that you're going to be using based on the leverage of your account and your account balance, and how much you're willing to risk for every trade. But usually all professional traders don't risk more than 10% of their account for every risk. For every trade is actually down to something like 1 to 2% for every trade that you risk for, which is like the best way for risk management on every account size. No matter how big or small your account is, you don't have to risk over 2% of your trade. 10% maximum per trade, but that's basically how you choose your position. Once you choose your position, you enter it, and then you let the market decide whether you're right or wrong by setting your stop loss and your take profits. So basically, as I mentioned, you need to have a broker. So I'll suggest that you go search on the top 100 brokers that people are using out there, and then take a look at the top 3, top 5, and then select which ones work best based on which in the country you are situated in. So you want to take a look at the withdrawal time. You want to check at the method that they use to withdraw for withdrawal processing, as well as to fund your account. And you also want to take a look at their basically the whole structure of the thing, right? Like is it regulated? Is it a good broker to use? So you just want to look at the leverage and everything, all those kind of things. So just go through that, select your broker that you think you're gonna work for you, and then open a demo account with that. Once you practice the techniques and skills that you're going to get from this course, you just go through the demo account. Remember, demo account is basically virtual money that you use to practice and to get to understand basically sort of strategy testing. So you just have to analyze, and it's almost like you're trading real money, but you're trading with fake money that you can refill anytime and you cannot withdraw. But once you're done with that and you got your broker sorted out, the next thing is to analyze the market. So analyzing the market, this is the very key thing, because without it, if you just enter a trade based on emotions, that means that trade most definitely won't end very well as you might want it to end. You now understand the basics of choosing a position, but you need to understand that there's only 2 options that you have here. So when it comes to choosing a position, you only have 2 choices. It's either you're buying. So the quick terminology that you might need to get used to, let me just type it out here for you. So when you're buying, that means you're saying that the market is going to go up. So you're expecting the Euro USD, again we're going to use Euro USD as our example. So you're saying the Euro is going to go up, it's going to gain momentum over US dollar, and you're saying the market is going to go up. So either when you say you're buying, you're saying the market is going up, so it's basically going up, right? That means market is going up. But then the quick terminology that you must need to understand for this is that it's either you're buying or you're going long. So you're going long or you are bullish on the market. You are saying the market is bullish. So these are the 3 terminologies, the most common used terminologies when it comes to when we say, okay, you're entering a buy position and you're saying the market is going to go up. And then when it's going down, which is the other option that we have, we're saying we're selling the euro against the US dollar. So when you're selling, we mean the market is going down. So when the market is going down, that means you are shorting the market. You're shorting the market. So it doesn't really mean that you are holding a trade for a short-term period of time, but you actually just shorting the market. So meaning you are selling it. You are saying the market is going to go down. So another word for that is also bearish. So as we have explained a little bit earlier on. So these are the 3 terminologies very common in this market that you might need to get used to and just understand what it's all about, right? So those three right there. So it's either you are buying, you're going long, you are bullish on the market, or you are selling, shorting the market, or you are bearish. So those are just the two options that you have. So we're going to use this scenario right here that has been illustrated right here, so that to give you a better understanding of the two possible outcomes that can happen when you enter a trade. So the one is going to be positive, the other one is going to be negative, because remember, the market can only go in one direction. It cannot fulfill both sides, so you can go both buy and sell at the same time, right? So it's either it's going down or it's going up. So let's say on the Euro USD again, let's say you've done your analysis and you have chosen your position and you chose to go buy. This is the outcome that would have gone on with this trade, specific trade right here. So at the current price right now, this is the price right there, and then let's say you buy this one. So if you bought this thing, that means you bought it right here at this value right here, right around this area, and then you cover the spread. The spread is basically the commissions that your broker would take from you. So when you enter a trade, it will always start in losses, so don't expect a trade to start in blues every time. So it will start in losses, or it will break even. So depending on how much the spread is on that specific currency pair, you start in that amount as a negative, also based on your lot size and everything. So it's usually about I think about 2 pips on a standard lot size. So on a standard lot size, which is the standard as we explained the lot sizes, and then so it will depend on the currency pair that you're trading. It will also depend on the broker itself. So it is a commission that the brokers get every time that you pay that you open a trade. So to be able to cover that amount, you start here. So let's say you bought your position, and then later on during that day you came back and then you saw that you were actually right here. The market has actually moved in your direction. That means now you are up here. That means you are in profit. So if we just take a look at these numbers right here, so the market is now at that number. That means at that point you have made 32 pips in your direction. So those 32 pips are actually your profits. So now the amount in US dollar will depend on your leverage. Firstly, it will depend on your positions, how many positions you actually entered on this market. So if you have entered according to this, so if you had entered with the standard lot size right here, you will see that you would have banked in a $320 profit on this account right here. But let's look at another possible outcome that would have happened in this scenario right here. So let's say you said, okay, cool. You think the market is actually going to go down. It's actually going to go down from this point right here. So let's say you actually came here and you say, okay, cool, I'm actually going to sell this right here, and then you sold it right here, and then later on in the day you come back and you see the market has gone all the way up here. So that means your analysis was wrong. If you had a stop loss, it might have been triggered somewhere around there. Or if you did not have a stop loss, it just means you are deep in losses right now. So the only thing is to obviously cut your losses short. The best advice that I can give you in this market is that you need to cut your losses very small. Let your profits run. So cut your losses short, let your profits run. So if you see that the market is no longer going in your direction, the sooner you cut it, the better. Okay, that's the only way to actually really survive in this market. So in this scenario right here, you remember here you have gained 32 pips, but remember there's also the spread. So that's why this one is actually gone 36 pips. That just means the spread was roughly about 4 pips in this trade. That's why you would have been at 36 points, because it's exactly at the same point, but it's now the loss is going to be a bit more because that's included with the spread. So anyways, this is basically the two outcomes, the two positions that you can open when it comes to opening your trade. And basically that's how a basic trading scenario can go on about. Only two possible ways is either you're buying or selling. It's either you're in profit or you make a loss. So let's go on to the next lesson.